Your return as an investor in stocks is based upon two things. The quarterly dividend that it pays you, that's your money to keep, to do with what you want, and that is pretty much a guaranteed, although they can always change the amount, lower it, or eliminate it if they were so inclined. And then the other reward you get is when you ultimately sell the stock, hopefully at a higher price than what you paid for it. That will likely happen if you don't let emotions get involved. And when you see, I don't know about you guys, but I know this. Almost every time I have bought a stock, there is somebody back in New York watching. And as soon as I buy it, the stock goes down. Okay? Somebody starts selling. I can buy any stock, and I can tell you within 15 minutes, they start selling that stock. I don't know how that happened. But I imagine many of you feel the same way too, okay? So, the time not to sell is when the stock's down. And all stocks will go down and will go up, but ultimately stocks go up much more than they go down. And quite honestly, I would follow the wisdom of Peter Lynch, where he said, use index funds. Buy the S&P 500 index fund. Instead of owning a bunch of different stocks, own the 500 biggest companies in America by using an index fund. Fees are really, really low, very low, less than 1/4%. And you're gonna ride the market up, and you're gonna deal with those years that come up every once in a while where it goes down. But long term, it's dramatic. By the way, I think did I talk about the crash of '87? Real quick, because we got to get you guys out of here, and it's like my bedtime right now. So, just to put things in perspective, on October 19th, 1987, the Dow Jones Industrial Average in one day. The market overall lost 25% of its value in one day. One day, okay? Today we have the markets go down 1 or 2%, and the talking heads on CNBC call it a crash. Most of them weren't born in 1987, so they have no remembrance of this. I remember that day as if it was yesterday. I was working in the financial services industry at the time, and remember back in '87, we didn't have the internet. We didn't have people accessing information that way. And so that the only way people knew about what was happening that day was word of mouth. And it was scary. It was really scary. Wow, what if this is really it? What if this is it? Okay. Dow Jones Industrial Average on that day closed at 1,736. Today we're at 17,000. It was the greatest buying opportunity in the history of the stock market. But do you think anybody was buying stocks on that day? Probably not. And by the way, you don't always necessarily want to buy stocks, okay? There are times when a mutual fund would be a better option for you to explore, okay? Let me give you an example, a couple of examples of that. If somebody came up to me and said, Chamberlin, you can buy one technology company. You're allowed, we're only going to give you the opportunity to buy one technology company. What one would it be? Apple, Microsoft, Qualcomm? Geez, I have no idea which one. So what am I going to do? I'm going to buy them all. I'm going to buy them all. I'm going to buy an exchange-traded index fund that owns technology stocks. And you're going to have a portfolio of probably 50 to 100 technology companies in there in a very low-fee investment environment. And you're going to be able to benefit from the growth in that industry. Same thing with healthcare. Somebody said, Chamberlin, buy one what one healthcare company would you buy, Chamberlin? I have no idea. Would you buy an insurance company? Would you buy an HMO? Would you buy a hospital chain? What would you buy? I don't know. So I'm going to own them all. I'm going to buy a healthcare exchange-traded fund, index fund. That's how you can get real good diversification in an industry that some people really believe you should be looking at.